Hi, everyone. Courtier au chapeau, broker with the hat. I'm here with my very good friend and colleague, Morgan, the mortgage guy. Hi, Morgan.
Yes. Hi. Thank you for having me, Peter.
No problem. So some stuff has come on the news lately. Last week in the Toronto Sun, I saw a headline that seemed to be very sensational.
Yes.
A survey shows 1 in 4 homeowners think that they might lose their homes with the mortgage increases. So to me, this seems very sensational and frankly wrong on a couple of levels. One, they're putting a headline as fact, but it's a survey of homeowners. They are not mortgage experts. So it's basically saying, this is a fact. We asked a bunch of people who don't actually know.
Yeah.
So that's not great journalism in my mind. And I want to ask you, is this factually correct? It seems to me that anyone who got a mortgage in the last 6 months was stress tested at about 5 or 5.5%.
Yeah.
So if it goes up half a percentage point or even a full percentage point over the next 8 months to a year, I don't see them losing their houses. But what do you think about that? Can you shed some light on this?
Well, thank you for asking me the question. And I think that there is obviously in the marketplace right now a large amount of anxiety, obviously because of a lot of external factors, from the war in Ukraine to, global warming and so on and so forth. And so to dive into that survey, it was actually a survey that was conducted by Manulife. They interviewed about 2,000 people across the whole country. And within that group of 2,000 people, they got 25% of those people that feared that they may have to lose their home. Now, you've brought up a couple of very important points. So we have a very controlled, very robust housing market in Canada. To qualify for a mortgage, you need to be able to afford an interest rate of 5.25. So it's important to differentiate between what you can afford and what you would like to pay, right? So of course, none of us want to pay more on our mortgage, but it doesn't mean that we can't pay more on our mortgage, right? So obviously, that's not going to be the case. We're not going to lose 25% of the market share suddenly by people selling their houses because they can't afford, even if it's a $1 or $2 or even a $300 a month increase. And one of the main reasons I think that that's especially wrong is, and you as a real estate agent can confirm this, is that even though your payment is going up, the value of that property over time, I mean, how much would you say a property gains in value in a period of say 5 or 10 years, right?
Well, historically in North America, since 1950, property values have doubled every 10 years.
There you
so
go.
That's 70 years of data.
Yeah.
1 or 2 years of data, I might doubt. 70 years, I think we can hang our hat on that to some extent. Look, life changes, the economy changes and stuff, but that has what has been going on. And even in this super increase that we've been having here in my neighborhood in NDG, we've had double-digit increases for 3 or 4 years in a row. I don't think that's not sustainable, and I don't think it's healthy.
No.
But going back to a 3 to 5% increase per year is a more normal thing. But you are going to get there with the value of your home. It's definitely has been proven, and yeah, that's the way it is.
Well, and so that comes to, so that's really important to mention that, these homeowners, they don't want to forfeit those gains because there are a couple of factors. When you look at anytime there's a spike in mortgage rates, and that you can go back again another 30, 40, 50 years, you'll see that the spikes are spikes, right? So they go up and then they come back down. So right now, the Bank of Canada, their objective is not to price Canadians out of home ownership. Their objective is to tamp down inflation so that Canadians, both homeowners and not homeowners, can afford to live. So their objective is not for your life to become so expensive you cannot afford to live, but in fact, make sure that your grocery bill doesn't get to the point, or your gas bill doesn't get to the point where suddenly you say, I can't afford to pay this. This has gone too high. So that's where they're trying to sort of moderate that by raising interest rates. So if you think about how the government is not trying to sink you, and that, yes, maybe there's going to be an uncomfortable increase for another year, maybe 2 more years. There's a bigger picture here, right? So if you have a property that's going to double in value every 10 years, even if for a couple of years the payment is higher than you would have been comfortable paying, even though we know mathematically you can afford to pay it, you wouldn't want to just walk away from all of that and then turn around and rent let's say, a very competitive rental market where it's not like you're renting at a significantly lower rate than your mortgage payment would have been anyway, right?
Exactly.
So, these are things to take in consideration. Obviously, a headline like 1 in 4 Canadians will lose their property if rates rise is a very clickable headline. Who hasn't clicked on that? Because, I mean, gosh, we've never heard such a crazy fact.
Exactly. And I wish that the standards of journalism were a little bit higher, because you can't put, it's like literally putting an opinion as a headline. Yeah. And that in many people's minds turns it into a fact. But yeah, those were a survey of homeowners, again, who don't understand the big picture as you have explained it. And so that's just an opinion and not a very informed one. So for them to present that as fact is frustrating, but that's our job. You and I working together with our clients, trying to put some reality into the situation and make people understand the context. We're not going to ignore it. No. Interest rates are going up. There will be an effect, but it's not going to be what the sensational headline.
No, in fact, the thing I always say is, obviously, if you're in a situation where you feel anxiety and you feel insecure about the decisions you have made or are thinking of making, obviously, it's important not to read that 500-word article on the Toronto Sun, but to speak to the professional that you're working with, because they can actually lay down on paper the actual reality for you. And I did myself some quick math, and this is really, so right now, let's say you got a mortgage and you got it, I don't know, 2%, okay, because we were getting very low rates. The math works out that if in 5 years from the time you got that mortgage, your new rate is 3% higher than the rate you signed for, which is pretty much on par with what the Bank of Canada is saying in the sort of the more aggressive outcome could be, is that you would go to, from 2% to say 5% in interest. You would have to earn 1.5% more year over year at your job, so that your monthly income in your pocket after taxes compensates for the mortgage payment increase. So when you put that down on paper and you think, well, in 5 years, am I going to earn an average of 1.5% more? I would hope so. Not everyone, unfortunately, will, but I would think that the majority of homeowners who had stable incomes, qualified for the mortgage that they took, should be able to sort of, on average, gain in their annual income, right? If you think about how much that person was earning 5 years ago, I'm sure that most of our clients would say, yeah, I was earning a little bit less than I'm earning today, right? So when you put that down on paper, you think, actually, it's not so scary, it's not so dramatic that suddenly the whole market is melting down and everything is going to hell, right?
Right. No, yeah, absolutely. And I appreciate that perspective. So, yeah. Anyway, so I hope everyone learned something about this. Yeah. You can reach out to me, a broker with the hat, Couture Chapeau, or Morgan, the mortgage guy. Yeah. Thank you so much for your time.
Yes, thank you. Yes, absolutely. We'll talk again soon. Cheers.